So give us your take on where we are right now. The stock market actually was doing pretty well till Friday, and then it backed off some. But did we learn anything this week about exactly where we think we're headed?
I think this week was, this week was a week where we heard a lot of really negative headlines around potentially sticky wage inflation. I mean, the auto worker strike. We're seeing signs of, kind of trends that we were expecting to mean revert very quickly, remaining high. So our view is we're not necessarily out of the woods yet in terms of the Fed controlling inflation. And we think that the mistake to be made at this point is betting that the Fed will start cutting aggressively next year. We don't necessarily see that as a slam dunk, and that's what a lot of investors that we speak to are expecting. So there's this theme around resumption to what happened over the last 10 years, and our view is that we're at a break point where we may never see these low rates of the last 10 years ever again. And in fact, I think it's important to remember that what we saw over the last 10 years was an anomaly. Negative real rates are not the norm, they're the exception, and where we are now just feels a little bit more like firm footing.
What does that tell you about equity valuations?
Yeah.
Where are we on equity valuations? 'Cause obviously that's sensitive to interest rates because of the discount rate and how it applies. Do we basically feel that we're properly valued in the equity markets? Are we overvalued, undervalued? Where are you?
So I feel like the S&P 500 right now is kind of a tale of two cities. And there's, the benchmark isn't a broad market composite like it normally is. It's a top-heavy benchmark where 30% of it, roughly, is made up of 7 big companies that play this mega cap tech growth theme. And that area of the market is relatively pricey. Perhaps that's where we will see the greatest growth over the long term. But I think what has yet to happen is these companies need to recalibrate to an environment where the hurdle rate is no longer 0. It's a lot higher than 0. We just saw the Fed move us from 0 to 5 very quickly. I think that when you take the broader market index, you see a very different valuation story, a very different growth expectation story. And I feel really bullish about the equal weighted S&P 500 because I think what a lot of companies are doing right now is smart. They've done the right things. Over the last 10 years, they haven't necessarily taken on a lot of floating rate risk. They've paid down debt in many industries, energy, industrials, materials. A lot of these manufacturing exposed sectors have been starved of capital and have gotten leaner and meaner and now look like they're focused on efficiency, which I think is the best bull case for the next 10 years, and we can talk more about that.
But does that suggest perhaps, Savita, that there will be some separation of the companies who can really get their head around increasing productivity, being more efficient, as you say, cutting costs, and ones that may have a tougher time at that? Because some people do that better than others.
Yeah, absolutely. It's a story of the haves and the have-nots, who gets it right and who doesn't. And I think that's where fundamental analysis, which hasn't really mattered for a very long time. It feels like all you wanted to do was buy the RIP, focus on the index. And now I think it's a time to get in the weeds, into the fundamentals. And that's where you can figure out which CEOs and CTOs are figuring out how to use technology to replace more expensive workers, how to make markets more efficient. We're seeing this already in a lot of industries, like, for example, restaurants. Our analysts have been writing about how today's kitchen looks so different from the kitchen 10 years ago in terms of automating and getting a lot more labor light, if you will.
So that's automation. What about labor? I mean, we did have that UAW strike in specific plants.
Yes.
We don't know where that's going exactly, but it's against a backdrop of larger pattern of labor unrest and demands for workers. Could that cut into some of those margins that maybe productivity would give you?
Oh, absolutely. I think that right now there is a tension between real inflation and financial asset inflation. And what we saw for the last, during post-financial crisis was this wonderful frictionless environment where there was barely any inflation to speak of. If something got expensive in the US, we could move it somewhere else or we could import from anywhere we wanted to. And now we're in a very different setup. The disparity between the wealthy and the poor has just grown larger. We all talk about this, but I think what we're seeing now is real evidence of closing that gap. So that's going to be bad for some corporations. And I think where it's going to get difficult is for companies that haven't been able to really think about how to navigate a higher interest rate environment. And again, when I think about the indices within the market, The S&P 500 is this top-heavy benchmark, and then the Russell 2000, which are smaller companies. A lot of the companies that are in the Russell today aren't necessarily these economically sensitive growth companies. It's a lot of these so-called zombie companies that have, were IPO'd in a much friendlier environment and are no longer able to handle this rising rate shock, if you will.
Savita, taking a look at all of that analysis, what does it indicate to you about where we're going next as we look toward 2024? I mean, as one of our L's, you're at 4,300, which is, by the way, right at the median number right now.
Uh-oh,
for the L's. That's probably good, probably right. But what can you tell us about where you think we may be headed as we go into 2024?
Yeah, so I mean, I think that what we're facing right now is, again, a market that's likely to right-size technology. I think that tech shrinks as a percentage of the S&P 500, and we see leadership broaden out to other old economy sectors that are actually using these new tools to get more efficient. Next year, I think, could be a good year for earnings. It could be a good year for nominal growth. I think the trick is figuring out which companies are doing it right and which companies are going to become, obsolete. And that's where the challenges remain. So it's really a stock picker's market. But I think that if you want to buy an index, the equal weighted S&P 500 to me looks pretty interesting. These are companies that are relatively cheap. The trading value is, I think, something like 15 times earnings, which is, a relatively average valuation, not expensive, not cheap. And my sense is that we've all gotten used to just one sector and one theme driving equities, but we could be in an environment where the themes broaden out and we see, different stories for different sectors.
One last quick one, if I could. Are we as diversified as we think we are, given what's going on with the indexes?
So this is where it gets interesting. I think that portfolio managers and active managers are in a tough spot because we've been in a market where 7 stocks have been driving the index, and they're almost forced to own these companies. We're now at a point where 1 out of 10 active managers has more than 40% of their portfolio in 5 companies, not diversified at all.